All right. So the financial budget is where we're starting. And the part of that table that I showed you in the very beginning of what is the master budget and what are the components of it was the financial budget, right? I hope you remember that. So it was the on the bottom, right? The financial budget. All right. So the parts that it consists of are the cash budget, right, or statement of budgeted cash receipts and payments, then budgeted balance sheet and budgeted statements of cash flows. All right. So just to remind you a little bit, we started with the operating budget and we said that there are certain components to it, right? We started with the sales and then inventory and so on and so forth. And then the third part was the capital expenditure budget, and now we are talking about the financial budget. So what is the cash budget? The cash budget is our projected cash receipts and payments. The budget balance sheet are our projected for assets, liability, and stockholders' equity accounts. And then the budgeted statements of cash flow is our project cash flows from operating, investing, and financing activities. All right. So as we said, let's talk just a little bit in details on cash budget. So the cash budget, we said, is the same as the statement of budgeted cash receipts and payments. So practically what it does, it details how to go from the beginning cash balance to the desired ending balance. All right, so we start with some desired beginning amount and try to trace it all the way to the ending balance. So there are apparently 4 parts to it. Okay, let's make sense out of them. Cash collections from customers, then cash payments for purchases or our inventory, cash payments for operating expenses, capital expenditures. Capital expenditures are our long-term assets, right? And then all the cash collections, payments depend on revenues and the expenses. And those would appear in your operating budget, right? And that's something that we already have, right, by that time. Okay. So mainly this is why we cannot prepare our cash budget until we have that operating budget in place. Okay, so let's look at the example. Okay, so our cash budget is a statement of budgeted cash receipts and payments, and this is how it looks like. So the bottom is our sales budget, and then what we're going to try to derive is the budgeted cash collections from customers right now. Okay, so 2 sources, cash sales and collections of accounts receivables. So let's look where are they on the sales budget. Am I writing? All right, we'll just go like this. So let's look at the example of our Greg Tunes. So our sales are 60%, right? Cash sales is 60%, and then 40% are on credit. So the 40%, what we're doing with this 40%, we are collecting them the month after the sale occurred, right? We say credit collections 1 month after the sale. Okay. So we have 2 parts. Let's look at this. We have 2 parts. We have April's cash sales from the budget, and we have collections of March credit sales, right? And they're all in here. Correct? Okay, so let's try to trace. We have 46,000 right here, right? In our budget cash collections from customers. And what are they? They are 30,000 for the cash sales, and there are 16,000 right here for the 1 month after the sale for the credit collections.
And that's based off March's March.
That's right, right? It's 1 month after, okay? So pay attention that it's 1 month after that. All right. So let's look at the other part of our cash budget. We said that the second one is budgeted cash payments for purchases. And what do we have here? So we have all payments for purchases, and that consists of two parts. The first one, we have payments during the month of purchase, which we're going to say is 50%. Okay? You see it right here, right? And then payments following the month of purchase, again, it's our 50%. Okay. So what do we see here? We are saying that it's, again, Greg's Tune, the same company. So they pay for their inventory purchases 50% during the month of the purchase, and then 50% after, right? That's what we said we have in the second part. 50 of the last month, and then 50 of this month purchases. All right, so we have the next part, which is your budgeted cash payments for operating expenses. Now, these are just a tad complex, so let's look at how we're dealing with the operating expenses. All right, so we're going to use our operating expenses budget and payment information to compute all our cash payments. So again, we're going to say that 50% of current month's salary and commission, and then 50% of prior month's salary and commission. Okay, just for the simplicity of it, we're going to call it 50%. When you are actually going to be dealing with the problem, it can be anything else. Okay, it's not always 50%. And then payment for rent and miscellaneous expenses are in the same month. Okay, so let's look really quick. What do we have here? We're going to use our operating expense budget, and yes. All right, so let me show you how they're going to, what numbers are we going to use from where. All right, so the second part that we're going to use are our cash payments for operating expenses. So what Greg is going to do, he's going to pay, just again, let's look at the conditions that we have up there. Greg is going to pay half a salary in the month incurred and half in the following month, right? Hold on. And then our operating expenses also, okay, so here you see 50% of last month's salary expenses and 50 of this month's salary expenses. All right. So the next one, let's, if you remembered from the previous slides, we said that operating expenses are going to include our rent, right? That's 2,000 right here. And then we said you've seen that, right? And then we also said that $500 is going to be our depreciation, $200 is insurance expense, and so on and so forth. Those expenses are also going to be added. Let me see. Also, look at this. We're going to have some miscellaneous expenses that are 5% sale. Okay. Well, now let's look at this. Just a second. Come on. Okay. Okay, so we have, as you see, we have some, we're going to utilize the, just give me a second. The operating expense budget, we're going to utilize, and so some numbers that I've just named are going to move, right? Let me see real quick. Let me show you really quick. Okay. So we'll try that on the example right now, just try to get the flavor of it. Okay. The only thing that I also want you to pay attention here to is that depreciation is a non-cash expense, okay? So here, our depreciation expense, this is a non-cash expense. And so this particular one is not going to be included in the budgeted cash payments. So it's not included in your budgeted cash payments for operating expenses. Okay. Now the insurance, as I said, is going to be added, and it's prepaid in the prior quarter. Okay, so let's go next. Now this one is a bit also more than you would want to see. Okay, so what is the cash budget, right? We said that those are the components of the cash budget. Now we're putting them together. So to prepare that cash budget, all of these are in your book, all right? Hope. Let's start with the very beginning of cash balance, right? This is our, we said that we're going to start with the beginning cash balance, and we're going to try to trace all the amounts all the way to the ending cash balance, right? So we looked at all different parts of it. Now we need to put it together. All right. So what are we going to add to this? We'll add different budgeted cash collections that we've just worked on slides before. Okay? That's going to help us to determine what cash is available. So then what we're going to do, we'll subtract, just a second, we'll subtract different payments, right? All the cash payments that we've just made, some of the operating expenses, and then whatever the expenditure that we have. Might be none, right? Okay. Then what we're going to get is this ending cash balance. So let's look at this. Okay. So the beginning balance is 16,400, right? Okay. So just by the something that's going to be given to you is also the minimum cash balance desired. Okay. It's right here. It's 10,000. So what are we going to do? We're going to say that before financing, we want the ending cash balance 2,950. Okay. So what are we going to do next? We're saying that once we are budgeting this 2,950, I'm looking really careful to the numbers, and I want you to look very carefully here, all right? Because then we'll do examples, but make sure we're looking at the right numbers. Okay, so 2,950 is our budgeted cash balance, ending cash balance before finance, sorry. What does it mean? Our ending cash balance is 2,950, and then we have minimum cash balance desired is $10,000. It means that we're falling short of $7,050, right? What is required? So cash excess or deficiency, right, is the next, maybe here, is right here, right? So this is the number which you did here. You took this number, and then you subtracted the second number, right? So this is 1 minus 2, okay? That's your $7,050. That's your deficiency. Okay, so to be able to make this short-term financing, we're going to have to secure existing line of credit. Okay, so how we're going to finance this cash deficiency? This is right here. That's your cash balance right here. Okay, so what we're going to do here, let's not go into details right now. What we're going to do is calculate how we can, so if we are going to borrow that $8,000, our total effect of financing $8,000. So I'm pretty sure we have an example on this. So that's going to be your inflow in April that's going to help you to finance that cash deficiency of $7,050, okay? All right, so how did we get 10,950 as an ending cash balance? That's your financing of $8,000, and then the ending cash balance before financing, right? That's going to give you $10,950 right here. Okay, how we calculate this we'll go over just a bit later. And let me see, maybe if I have details, I'll go over with you. Okay. All right. So as a manager, that's all numbers, okay? Numbers, it's important for you to understand them, but more important is to understand what is it on the budget, okay? Don't try to memorize what numbers are where. Try to understand what does it mean. Okay, so once as a manager you make a decision to put that budget in place, you believe that it's a good budget, you need to get your employees to accept that budget, right? So if we were talking about the Greg's tunes, what Greg is going to do, he's going to try to understand what is the most important part of that budget for Greg, for that budgeting system as a whole, right? So despite all of those numbers, that's what I was trying to tell you. It's bits and pieces for you important to understand, but despite of all those numbers, it's not the mechanics that's important. It's really getting your managers and employees to understand how you arrive to that budget. Okay, when you're presenting the budget, you're not going to go through all the financial details of it. You're going to want to persuade the bottom line of it, right? Okay. Okay, so what are the most important? The most important is getting managers and employees to accept the budget. Managers must motivate employees to accept the budget's goals, right? Not to question it, but to actually accept it. How can they do that? There are a couple ways. Managers must support the budget themselves, right? They need to believe, they need to understand the numbers, and managers must show employees how that budget can help them to achieve goals, and participate in developing the budget, right? For the employees to take part collecting the numbers or collecting some little goals, right? Maybe not the whole budget, but bits and pieces of why we need to change some components of it. Okay, so now just for you to understand that example of the crazy complex budget is not that scary, and we're going to do some parts of it to understand how do we calculate bits and pieces of it. All right, so don't get scared. I know that those slides were quite complex. That's not what you need to pay attention. You need to pay attention, what is it really saying, what are the numbers that you're looking to derive there, and not necessarily what the percentages are, right? Okay, so let's try this. So we're going to do this 22.5, and I think I've seen it in your homework, right? Okay, so let's now assume that this company sales are collected as follows. November sales totaled 400,000. It's from your book, right? S22.5. December sales were 425,000. Now, what's given to us is 50% in the month of the sale, 30% after the sale, and 18% 2 months after the sale. 2 are never collected. So you see how your percentages can change? All right. So let's look. Budgeted cash collections from customers, a little bitty piece of that big budget that we looked at, right? Just a part of the cash budget. Okay, so what do we have here? We want to prepare a schedule for the budgeted cash collections for January and February, and then round answers to the nearest dollar. So pay attention, right? You have in the month of the sale, you have after the sale 2 months and never collected, and you also have your November sales of 400,000 and December of 425. All right, so how are we going to calculate this? We have cash sales of 50% of current month. And then we have some collections of sales, 30% of prior, month sales 18 of sales 2 months ago, and then total cash collections. So try for literally 2 minutes. So some cash sales 50% of current month. What is the current month? All right. Do we know anything on current month, January? Almost showed it to you. So open your, do you have your, let me show you, let me give you some numbers. Okay. So November we have, December we have, let me just add some numbers. January, your January is, I'm just going to say J, okay? I'm not going to write all of it. 1, 5, 3, 0, 0, 0, 0. And then the February is 6, 6, 5, 0, 0. Okay, so we're right here. All right? Let's start with the January. So cash sales 50% of current month. We know that it's 1,530,000. So what we need to do is divide by 2, right? So we'll take January number, divide by 2, and that's going to be your cash sales. Then we need to calculate collections of sales. That's going to be 30% of prior month, right? And then 18% of sales 2 months ago. So give me your total cash collections number. Anyone has the cash sales calculated? 765. Okay, 765. All right. Next one, 30%. 127. Okay, 500. 18%. Can you go in the back and see what they're doing on the computers?
Okay.
And make them close it if it's not.
Okay.
All right, so what's the total cash collection? Okay. Okay. So not as scary as that huge table looked like, right? So how do we calculate February? What is the cash sales? 332,500. Okay, anyone else? 30%? Guys, you all have your computers up and somehow you can't calculate something divided by 2? Come on. Okay, 459. Thank you. And then 18%? 76,500. Okay, and what's the total? Okay, so can you do something like that?
Yes.
Okay. Okay, so we'll go a little bit back. Hold on. Let's do right now something different. 22.6. I thought 22.3. No, 22.6 is what we're going to do. So assume Grippers pays for inventory purchases 50% in the month of purchase and 50 in the month after purchase. What we're going to do is budgeted cash payments for purchases for January and February. Let me see if we have all the numbers. I have right here. Hold on. I don't want to give you all the numbers. Hold on. Let's do this first. Yes, let's do this number. It's 22.7. Sorry, we've done some of that. Let's do 22.7. So we will have some amount in cash on January 1st. We're going to assume that they have cash payments for operating expenses, including salaries, plus 1% of sales, all paid in the month of sale. The company requires a minimum cash balance of $10,000, and we want to prepare cash budget. Okay, so let's look how we're dealing with this. So open, if you have your books, 22.7. So what are the components of our cash budget? Let's look at this first. We have beginning cash balance, and we're going to trace it all the way to the ending, right, the desired one. Here we have our beginning cash balance to cash excess deficiency. So what we're missing here is that financing part, right? Okay, so let's work on this. So how much we need to borrow by the end of the February? I'll help you with the numbers that you're missing, if we're missing anything. We said that total cash collections are going to be in the amount of, in the previous exercise. What was the amount? Anyone written it down? From the very last exercise that we did, we found total cash collections from customers. It was $964,500. Okay. Anyone remembers what it was for February? $868,000. So I want you to tell me which one, what numbers do we need here? What are we missing still? Okay. Purchases of inventory. What else? Operating expense. Where am I paying? Where am I putting my $12,500 in cash on hand? Oh, we have it. Sorry, wanted to quiz you. All right. What about salaries? Where are we going to put it? Okay. So what is it going to be? So we have 50,000, right? And then plus 1% of what? What are our sales? So what would be a 1%? All paid in the month of sale. So it's in the month of sale. All right. You're saying it's 9,000. I'm just going to write it here.
Let's assume you collected 1% of the cash collection.
We said all paid in the month of sale, right? The operating expenses, total number. 1% of sales. Right? All cash collections. Okay, so you're saying it's 9,645? Okay. All right. What is our cash available? What is it? You said it's beginning cash balance plus cash collections from customers, right? Okay, so this is 1, this is 2, so this is 1 plus 2. All right. Okay. Okay, so we need to figure out our cash payments, right? Okay, I'm going to give you this, because we don't have all the numbers. So this is 622, 500. Oh, I'm sorry. Okay, and the operating expense is 50,000 plus 1%. So I'll give you that sales number. So the sales number is okay. So some of it was on cash, some of it was not, but it was all collected. So let's calculate 1% of 1,530,000. Okay, so what was the total? So now what we're going to do, we'll take that 1% of sales and add it to the 50,000, right? So what would be the total of operating expenses? 65,300. Okay, so what can I do right now? What am I getting? So I'm going to take this 3 and 4, and I'll add 3 to 4, right? 687, 800. Okay, yes. Well, that's what you calculated as cash, right? That was 1% of the cash collections from customers. Okay, and there was another part that was a credit that was not given to you. So I'm just giving it to you. All right, but you calculated it right. So if there were no credit payments, then it would be just fine. Okay?
So it's 50,000 plus 1% of sales.
Of sales.
Paid in a month.
No, it's 1% of sales that were paid in that month.
And sales was 1.53 million. Right?
Yes, that's the total.
So what is 9,645?
This is the 1% of this number.
Okay, so we're calculating 50,000 plus 1% of sales plus 1% of cash collected.
No, your sales are done. Okay, you made some sales for cash and some sales for credit. So some are just not given to you, and I'm giving you to that number. All right? But you collected all of it. So if it's paid, for example, 2 months later, you already got that. It's just whatever is collected that month, or all sales that you've collected that month. Okay, it doesn't matter how you paid it. We're just not having all the numbers. Okay, just giving it to you, not to calculate that right now. It's not the point. All right? Okay, so sales are given to you. They're all collected in the month. You're just calculating 1% of it right now. Okay, so what is the ending cash balance? How are we calculating that?
Cash available minus total cash payments.
Okay, so I'll take this, 5, I'm sorry, and I'll take what, this,
Yes.
6, so I'll subtract,
5 minus
okay, and what is the number that I'm getting? 289. Okay, cool. Now what else can I put? What is my minimum cash balance desired? How do I get the 10,000? No, where did you find the 10,000? It's given, right? Okay. So we have 10,000. So what is that number that I'm getting? You are saying it's 299? That's right, 279, right?
Why is 400 this
Deficiency if it's not enough. Excess if it's... No, it's either or, right? If it's in your brackets, you call it deficiency, right? If it's a negative number. All right, so the question is, will grippers need to borrow cash by the end of February? So we're still missing some information, right? So what am I going to do with this beginning cash balance for February? Yeah?
Why are you not subtracting 10,000 from the 269,000?
It's 289. I'm sorry. This is 8. Just slipped. I'm sorry. It's an 8.
Do you subtract the minimum cash balance every time?
Well, it's not going to make any difference right now because we're interested in February, right?
No, but I'm saying, do you always subtract the minimum cash balance? Like on the previous, so that when you first showed us how to do the example, you just stated that the minimum cash balance was 10,000. So that was never.
In the previous exercise?
Yeah, the first one.
Uh-huh.
How to initially show us how to do it.
Let me look at it. Just a second. It was in the example, 10,000?
When you showed us how to do this, initially you showed that.
Oh, that's what you're talking about. Okay, and?
How come you didn't subtract? Or take away 10,000?
Okay, so we found the cash excess deficiency, right? Of some amount, it was whatever that was, right? And then we said that minimum cash balance desired is 10,000. We did the financing part there, right? So
We had 29.50 available.
yes,
The minimum was 10.
we had 29.50 available. We had 10,000 as the minimum cash balance desired, and so we found the cash deficiency of $7,050. But we said that we'll borrow 8,000, right? We did subtract, right? Because that's how we figured out that we need to borrow $8,000. Okay? Yeah.
If your cash available is less than your cash payments, do you still allocate a minimum cash balance because you don't have it? So would you still do it? So, so what I'm asking. So if your cash available was less than the amount you had to pay out, you would end up with a negative. You would end up with a deficiency.
Yeah.
You still have to set aside a minimum cash balance desired because you don't really have it to begin with.
Well, you have your minimum cash desired as something that you're going to do.
So it just puts you further into a deficiency.
Yeah.
Okay. Thank you.
Okay, so let's look at the February. What are we going to do there? So how am I going to find my beginning cash balance? Which number is it? Which number am I going to use? 279? It's my cash excess, right? Which one do you think? I'm going to use my ending cash balance, right? Okay. What is it saying? Will grippers need to borrow cash by the end of February? So because we aren't interested yet to borrow anything in January, we're just going to look at what, if anything, do we need to borrow anything in February? Okay? All right. So we have our cash excess. We're just going to disregard this minimum cash balance right now, and we'll move our ending cash balance of $289,200 right here. Okay. So what is my cash available? $1,157? Okay, next. How do I find my purchases of inventory? It's something that should be given to you, right? Okay, just checking if anyone is awake. All right. Okay, so operating expenses, not to calculate 1%. I hope you understand this. We have it at 56,650. All right. I'll give you that number. Okay, how do we calculate total cash payments? The sum of two, right? Purchases of inventory and operating expenses. What is the sum? 550. Okay. Next, what is the ending cash balance? How did we get 511,650?
1,157,645.
Okay, 511 and what? 650. And then what do I need to have at the next line? Minimum cash balance desired? 10,000. So do I need to borrow anything? Okay, so it's 501,650. Okay, cool. Okay, so let's look at the second one.
I have a quick question. Why do you keep subtracting 10,000 if you already knew the minimum balance?
It's just for us to see whether it's an excess or deficiency. You don't have to, right? If you're, well, you want to have at least 10,000, so this is like a check mark for you. Do I have enough or do I not have enough? Right?
It was like just a total of 9,000.
That's why when I'm using my ending cash balance for the February, I'm disregarding it. Okay?
Gotcha.
All right, so let's look at the budgeted balance sheet. So what part of the budgeted balance sheet is part of what? Budgeted balance sheet is a part of I'm going to do like 50% of the final on that question. So your financial budget, right? That's what we're talking about. So let's get back to this. Budgeted balance sheet. So when we're preparing our budgeted balance sheet, what do we need? We need to project each asset, okay, as well as liabilities and stockholders' equity. So let's look at parts of the budgeted balance sheet. We have our current assets, okay. Let me just mark it here. Our assets, our liabilities, and the stockholders' equity, okay. Okay. So what are we going to base these calculations on and our plans that we outlined with our management? We're also going to base it on all those balance sheets that we've calculated before. You remember that huge, humongous schedule of all balance sheets and which one follows which one? Balance sheets. Budgets. Sorry, slip of the tongue. Okay, so let's look at this one. What do we have here? We have our cash, our accounts receivable. Cash is 24,440. So you see there's a source. So that's where your amounts are coming from. It's all a derivative of all the previous budgets that we've done before. All right? Okay. So all the detailed computations we've done, right? As you see, this is the source that I'm talking about. You've done all of these computations. You are putting it together in one big budgeted balance sheet. It looks just like a balance sheet. Same parts, asset, liabilities, stockholders, equity. Okay, so the next part is our budgeted statements of cash flows. Okay, this one is, okay. All right, so let's look at this. Budgeted statements of cash flows. Again, let me show you how, what parts of it do we have here. It's our final step, right? So the statement of cash flows, the budgeted one, is the very final one. Go ahead. Okay, cash flows from operating activities. Again, Pay attention, there is a source. We've calculated the majority of it. So we have our receipts, we have payments, okay? We have cash flows from investing activities, from financing activities, and at the end what we want to calculate is our cash balance, right? Okay. So let me show you really quick where we're getting it. Cash collection budget and cash payments. Cash payments and our, again, all right, and then entire cash budget. So we're borrowing numbers from other budgets to put together our final cash flow, statement of cash flow. All right. Now the calculations, the sensitivity analysis. We've done some of it before. Sensitivity analysis and budgeting is also used. So what is it for? So our managers must prepare a number of calculations to develop that master budget, and we need to use the tool, right, that we'll call sensitivity analysis to identify how well that budget is adjusted. Okay, so master budget models for companies' planned activities. And okay, so technologies are going to make it more cost effective for managers to do the following procedures. First, we're going to conduct sensitivity analysis for the own unit's budget, whatever I have, right, whatever I develop. And those are what if techniques. Okay, what if something happens, what's going to happen, how is it going to impact the numbers on my budget. Okay, so it's determining the results on our predicted amounts and how they differ from the budget. So for example, if I have a change of sales slightly going up, slightly going down, how it impacts my budget. I'm going to also use spreadsheet programs, right? They're very cost effective. So they're going to let me do the what if budget questions and see the changes in Excel. Comprehensive sensitivity analysis also can be performed, and then managers react very quickly if our key assumptions underlying the master budget are not quite aligned with the budget. Okay, so combine individual unit budgets to create the company-wide master budget is another way we use technology to put together master budget consisting of all the little budgets, right? Okay, so what is the sensitivity analysis? So we already learned that how we can use the sensitivity analysis to check our budgeted numbers from the actual numbers. Now here, what we're going to also look is sensitivity analysis, a what-if technique that determines the results if predicted amount differs from the budgeted. Okay, so I think it was chapter 19 when we learned to use some of the techniques. So spreadsheet programs are going to help you to use the different sensitivity analysis for budgeting. Okay, that's going to make it very cost effective. So 3 parts of it: what if budget questions easily applied with the help of Excel. Okay, just a couple buttons and you can change the setting. Then it makes it very cost effective to perform more comprehensive sensitivity analysis, right? And we can also react very quickly, okay? And adjust that budget. All right, so let's look rolling up individual budgets. What is the procedure? We have different, let's say it's our Greg's Tunes, or whatever that company is. Let's call it Greg's Tunes. We're comfortable with them. So let's have 3 stores, store 1, store 2, store 3. So the quarters are gonna, company's headquarters, what are they gonna do? They're gonna roll up the budget data from all of the stores. into one income statement, right? So we have budget income statement for store 1, budget income statement for 2 and 3. And what are we going to do? We'll roll it to Greg's Tunes company-wide budget income statement. Now, another note here that all of the 3 stores are likely to use the same techniques and the same technology, so that roll-up is very smooth and easy for companies. And the spreadsheet that's used to prepare the budget is unified throughout the company. Okay, so what is the rolling up individual budgets and details? What we're having here is individual operating units roll up budgets to prepare this company-wide budget, right? There's a number of budget software, management software that can be used. ERP is the most well spread. ERP is the enterprise resource planning. Okay, that's a big system that helps to gather all the information throughout the company. So what does it do? It allows management to conduct sensitivity analysis on unit data, and it helps managers to spend much less time compiling, summarizing, working on it, and such, right? So your ERP is like a master system that's going to pull all the data together. All right. Let's do this. Okay, so we have a store that has right now this sales budget. Now what are we going to change? We're going to change the sales number from 64 to 80,000. Okay, so we have cash sales, credit sales, and total sales. The percentage is given to you. That number is for June, right? June sales are expected to be 80,000 rather than 64,000. So I want to see how you calculate all of this. Okay, we've done it.
Oh, you want the new total?
Do yourself, yes. And just give me your April, July total after you calculate it. Have you seen anyone? What are they doing? Change this number, right? So my total sales, 100% is going to be right now 80,000. Now what you need to change is the cash sales, 80% of the 80,000, and then 20% of the 80,000. Yeah.
The new number is going to be 262,000.
60 what?
262, 260.
Uh-huh. Got it. So any number, am I going to have any changes in July column?
No.
All right. So how did you calculate this? Anyone else? Yeah? you could do it this way, or what you could do is take 80,000, subtract 64, and add it to 246. That's it. So if you want to calculate every number, it would look like that. But what you could also do is take 64, subtract it from 80, and add it to this number, and you'd get 262, right? Because the difference between these two is 16, so 16 plus 246 is 262. But you could also calculate all of it. If I were to ask for the table, you would have to calculate it, right? You would have to, yeah, you would have to calculate. All right. So number 6, prepare performance reports. Yeah, let's do 6. Yes. Yeah, let's do